Okay, welcome to the March 7th edition of the Fats, Fuels, and Oils webinar. This week, we're going to talk a little bit about our outlook for biofuel margins or biomass-based diesel margins. And then I'm going to go through a preview of tomorrow's WASDE report and talk about the differences in our expectations versus where USDA was in its February report. So let's get started. All right. So for soybean oil, the main difference between our forecast and USDA's is really in the split between non-bio and biomass-based diesel demand, where we are 2 billion pounds above USDA in our expectation. And that is driven by my expectation that renewable diesel producers specifically will need to overproduce relative to what the mandates imply for capacity utilization purposes. Now, one of the ways that I've said that maybe this doesn't happen is if we shut down biodiesel production or biodiesel producers go out of business. And I bring that point up specifically because when we go through and talk about biodiesel margins here at the end, I'm going to show you what our forecast looks like, at least right now, and then talk about the changes that I'm probably going to make and why I think the forecast looks the way it does. Outside of that, we're generally in agreement. USDA has a little bit higher exports than we have, and I don't necessarily disagree with that number. We haven't really seen a pickup in the weekly data that suggests that that number is that the marketing year total will be closer to USDA's number than my number. However, there are, and I think I've talked about this before, there are like three sort of little calculations that I use based on the weekly data to try and project the marketing year total. And to be fair, those all suggest that that exports will be closer to USDA's number than to my number. However, a couple of those are based on sort of the average shipments over the balance of the marketing year in one way or another. And given that shipments so far during the marketing year haven't come close to what we normally see, I don't know, I've faded those a little bit. Now, it did look like for a minute that there was some potential for US exports to pick up a little bit, particularly given what's going on in Argentina. And US basis got a little bit more competitive, but it seems like the difference between prices at the Gulf and in Argentina have kind of stabilized, still with a relatively large premium for shipments out of the US Gulf. So I'm still comfortable at 500, but it won't necessarily surprise me if ultimately I have to raise that a little bit. The other one is non-bio versus bio. That's just a function of our feedstock demand assumption, and the data from USDA or the data from the EIA for December raised the implied non-biofuel demand in December more than the EMTS data implied, and so it raised it back above 1 billion pounds. And although just over 1 billion pounds, in December there were a lot of problems logistically, and so I think that that probably is the low, at least in the short term. And that would also maybe suggest a little bit higher non-biofuel usage. But where I'm struggling is that if even if biofuel feedstock demand is a little bit lower than I expect, obviously what I'll do with any decrease in that is add it to non-biofuel. But if it's not, just for the sake of argument, there really isn't any place else to reduce demand or increase supply without, well, there just isn't any place to do that. I mean, imports haven't really taken off that much, and exports already low, and my ending stocks forecast is as low as I really feel comfortable going. And so if biofuel feedstock demand isn't lower than my expectation, it's hard for me to figure out exactly where that additional non-biofuel supply is going to come from. The number that I put up is 74.5 pounds, which is the average daily usage implied by our projections here. That's about not quite 2 pounds above where we were last year, and a little bit less than that where USDA is predicting for 22-23. If you take the stocks number and divide that into the usage number, you get days of coverage. Essentially, if we stopped producing and importing soybean oil right now, how many days would we last until we ran out of soybean oil? It's not a number that I think gets used a lot in agriculture, but in energy, I think it's a number that gets used more frequently. I've looked at the relationship between days of coverage and price, and I think of it, in the same respect. If you're familiar with the oilseed balance sheets, USDA does stocks to usage, and that's a very common way to look at or try and understand price movement from year to year for the crops. It's similar to that, but right now our forecast implies that the days of coverage drops down to 21.7 days from 27.3 last year, and USDA's 26.6. Just in general, that shouldn't imply higher prices. Now, given where we are with the market today and what's going on, obviously it's hard to sit here and be super bullish. But what I'm trying to figure out is what's going to happen 3 months from now, 6 months from now, and reflect that in my balance sheets and price forecasts. And at least at this point, I still believe in this theory that renewable diesel producers will need to produce at a capacity utilization rate that is in line with where they've been historically. And if they do that, then it implies higher production than the mandates would imply, and would take more feedstock than USDA is suggesting. Now, historically, USDA has been cautious in the changes that they make to their biofuel feedstock forecast. So I wouldn't assume that you're going to see any huge changes in USDA's biofuel feedstock demand forecast in the short term. However, if my theory is correct, then I think probably starting later this spring, you'll start to see that number start to creep up as we start to use more soybean oil, as the average daily use of soybean oil starts to rise with growing feedstock demand. And this is our crush forecast, our average daily crush forecast. You can see that in February and March, I've got it going up a fair amount, and then kind of drops back down to basically where we were last year. And sort of the way that I look at this and the way that I set this traditionally has been that what I look at is in sort of the same calculation for soybean meal. So the monthly ending stocks for soybean meal relative to the next month's soybean meal usage. And if you look at that series over a long period of time, you can start to get some sense of where monthly crush should be. And based on our expectations for soybean meal demand, that's what sets sort of the February and the March crush. Now, the last 2-3 months, as you can see in the chart, have been below where we were last year. And so it's tough to have a ton of confidence in those numbers. But what I would say is that if this theory holds true, maybe crush is a little bit lower in the February, March, April timeframe, and then a little bit higher in the May, June, July, August timeframe, as biofuel feedstock demand starts to rise, and then oil share rises, and crushers start to match crushing volumes with oil demand. Now, that's something that I have expected to happen for a long time, and it honestly, it hasn't. We've gotten oil share up to, I think, 50% or a little bit over 50% at one point, but now we're down to around 40%. And a big part of the reason that we're down that low has been historically strong soybean meal demand. And this chart's kind of busy and it doesn't, it moves around a lot, but this is the average daily usage of soybean meal. And you can see last year and then the first couple of months of this marketing year, we were basically setting records month after month after month. Now, the last couple of months, we've seen a pretty sharp slowdown where we've dropped below not only last year, but below the 5-year average. And I think a very small part of the reason for that is declining cattle herds. Cattle don't really eat that much soybean meal. But I also think that there probably is something more in the poultry numbers that I just honestly haven't had time to look into yet to explain what's happened to meal demand. Now, even with declining domestic meal demand, soybean meal prices have been substantially higher than they've been, and pushing up on $500 short ton. And that's been due, I think, largely to the expectation that the Argentine crop wasn't going to be as big as people expected earlier in the year, and that U.S. exports would need to make up for some of that difference, which in the future is not going to be a problem. In fact, we're going to have to try and find places to put soybean meal, I believe. But in the short term, if you've got basically record domestic demand, and then you're also needing to fill in some of the gap for Argentina, then you get $500 soybean meal. Whether that can last or not, I think will depend a lot on what happens with bird flu this spring. Last year, we saw a really bad outbreak of bird flu, and typically what happens is you have a bad outbreak one year and then the next year is not really so bad. However, it seems like bird flu is so endemic in migratory birds now that expectations are that bird flu maybe won't be as bad again this spring as it was last year. And in last year, just to be clear, was historically high, sort of record high number of birds that were slaughtered because of bird flu, but that it could be higher than it has been in the in the past. And if that's the case, then meal demand probably is going to be weaker than we expect, and crush volumes could be weaker than we expect. It just depends again on this idea that that renewable diesel producers are going to overproduce relative to the volumes implied by the mandate, which really is kind of, there haven't been many times in my career where I felt like the market really all hinges on kind of one theory. This is probably the time that I have felt not necessarily the strongest, but the time that one thing like that has influenced really my whole view on the market. And so if that doesn't happen, or if you don't believe in that, then you can have a completely different outlook on the market than I do. And if it doesn't happen, then I'm going to have to dramatically change the way that I'm sort of viewing the market. So it's also probably the only time in my career that I have ever sort of put this much weight on a theory like this. But I have been looking at this for several months now, I think, and I don't see a way that doesn't necessarily happen. One of my colleagues today sent me over a Teams message where he kind of said, this is what I expect the shortfall in ethanol production relative to ethanol demand to be over the next 2 years. And it was substantial. I think in 2024, maybe he had 900 million gallons, which is about where I had been, and explains why the spread between the D4 and the D6 RIN is so narrow. It also implies that there's going to need to be a lot of biomass-based diesel that needs to come in to fill that gap. Now, of course, there still is the eRIN situation, but I think that has more impact in the longer term than it's going to have on 22, 23. And so that's part of the reason why I feel the way that I do about the renewable diesel capacity utilization, because there just doesn't seem to be sort of a relief valve for that capacity utilization outside of overproducing and exporting, or overproducing, building the RIN bank, or shutting down biodiesel production, which, given our estimates for biodiesel margins recently, seems like a particularly hard thing to do. And several weeks ago, I showed you our estimates for biodiesel margins and how they remain sort of at the upper end of the historical range. And again, you may have different estimates of biodiesel profitability than I have, but I think that that directionally and the amplitude of the margins is probably correct. And so I think it's going to be hard to affect that, and then that leaves me with the other two choices, which are build the RIN bank or overproduce and export. Either way, I think what has been happening, I think this slide is more about the past and the fact that it's changing right now, which is we've had record soybean meal demand and concerns about the Argentine crop, and then that could lead to greater exports, the supported soybean meal prices. As a result, then you get a lot of oil meal spreading that tends to depress oil prices and push oil share lower. If that reverses, then you get all of those forces sort of going the other way, pushing oil share up, pushing feedstock prices higher. Okay, on to canola. So In canola, one of the interesting pieces of data that we get, and I think I may have talked a little bit about it last week, but we got it at the end of I think we got it on the day of the webinar last week, was EIA's estimate for canola oil usage in renewable fuel production in December, which was 170 million pounds. And again, that was up like 40 million pounds from sort of where we had been, 30 or 40 million pounds from where we had been. Given the approval of the pathway for a D4 RIN from renewable diesel production for canola oil, we do expect an increase in canola oil usage in biofuel production, particularly since I don't necessarily expect a big slowdown in biodiesel production, and that is where most of the usage is now and obviously has been historically. But still, this is kind of the first indication. It's not a great indication because it's December. They didn't improve the pathway until sort of midway through the month, but renewable diesel producers were buying canola oil in anticipation of the approval of the pathway. So it does give some sense of what's to come, although again, I think it'll take another couple months for a couple of reasons. One, it's still early. Two, canola oil was particularly competitive with soybean oil in sort of the November, December period. It rose a little bit, but it's come back down and it's pretty competitive again. I think that is something that's probably a kind of a short-term situation. And I think that ultimately canola oil will have to go back to maybe not the entire premium or the entire historical average premium that we've seen between canola oil and soybean oil. But I think it will have to reestablish some of that premium. I think part of the reason that canola oil is so competitive right now is because you had a drought and then you had a good crop. And so during the drought, canola oil prices were particularly high. People probably cut usage a little bit, and then it typically takes a little while for that usage to kind of come back. In terms of the USDA report, there are differences throughout. Again, the difference in feedstock usage depends on this renewable diesel idea, although 379 million pounds is what we're predicting for renewable diesel usage in 22-23 is not a ton of usage, but it's significant, especially if you don't shut off the basically 13 or 14 billion pounds of canola oil, or not 14 billion, sorry, 1.4 or 1.3 billion pounds of canola oil usage in biodiesel. However, the real question to me is USDA's import number. So in February, USDA raised their forecast for US imports to 4.8 billion pounds. That's about 300 billion pounds above where we are. Now, it's we get most of our canola oil obviously from Canada, the vast majority of it. And so this kind of goes back to, it links back to what are shipments from Canada doing relative to last year, from Canada to the US doing relative to last year. Obviously, USDA's forecast implies a really significant jump, and we're not quite as high. When we get into the Canadian canola oil balance sheet, I'll talk a little bit more about that change. But I would like to raise my import number more, but I just don't see where that is going to come from right now. Now, maybe we get canola oil or rapeseed oil from non-traditional sources in greater volumes than we have historically. So imports from the EU or imports from Australia. We haven't seen that yet. And if anything, the increase in U.S. imports and in U.S. imports have been stronger than they in the first quarter. I think a couple weeks ago, or maybe last month when we ran through this, imports in the first quarter are up 20% from year over year. So the import number from the U.S. perspective looks like, okay, 4.8 might actually work. But if you look at the Canadian perspective, it's not that they don't necessarily have the oil to export to us, but just that the monthly shipments haven't quite been there to support that. And in part because of our lower import number, then we have a lower non-biodiesel usage number. Now, that's a number I would really like to increase, because I think that as feedstock demand grows, especially in the second half of the year, then you start to get more substitution of canola for soybean oil in the food manufacturing industry. And so to me, that number looks like it should be around 4.4, 4.5 billion pounds. But I just don't quite have the supply to get there yet. The other area where there's a difference is, and it's not a huge difference, but there's a difference in our production number. And that's mostly due to USDA's assumption about canola oil yields. Canola oil yields have been, I think, just a little bit lower than they have been traditionally. And I think that ultimately USDA probably is going to need to come down a little bit closer to our number more than we're going to have to come up. Now, that wouldn't give me the 300 million pounds or 350 million or 400 million pounds that I need to raise non-biofuel by, but it would help. The other area where I could get a little bit of supply is in the ending stocks number. I'm above 200, USDA is also above 200. We're not that far off from each other right now. And the reason that given the fact that I would like to take non-bio up, and I don't think imports are going to be as high as USDA is suggesting, would probably sort of suggest that, okay, well, ending stocks should be lower. But if you just kind of look at where ending stocks are on a month-to-month basis today, we've gone up year over year, and those numbers are basically driving a higher ending stocks number at the end of the year. Now, it may be that ultimately the non-biofuel usage is going to make me scrape every bit of supply that I can to raise that number. But right now, this is kind of where I am. All right, so diving a little bit deeper into the canola oil trade between Canada and the United States. This is U.S. imports of canola oil from Canada, and this is with a I think this is with no, this is just U.S. imports. That December number actually is a real number and not a forecast, so that should be a black circle. Apologize for that. But you can see we've been, like I said, in the first quarter, we've been above where we were last year, and certainly well above where we are relative to the 5-year average. But we've got that kind of coming down as we go forward. And part of the reason that I expect that change, and maybe it doesn't happen in January, maybe it happens a little bit later than that, and U.S. imports are a bit higher. But part of the reason that I expect that change is that we are a fair way into the Canadian marketing year. And so I have a better feel for what I think Canadian exports are going to be than where US imports are going to be. And so the Canadian export number really drives my US import forecast. I forecast out Canadian exports on a monthly basis to the US, and then I take that total and essentially apply a differential between what we've seen historically and in what I expect Canadian shipments to be. Now that differential is risen. If you total it all up for the marketing year, it's typically about 75 million pounds ish or so, which is not a big difference. Again, most of our canola oil imports come from Canada. Last year, it pushed up to maybe 175 million pounds. And this year, I think I'm starting to use 200 million pounds and starting to kind of use that going forward. But so that number then sort of determines where these month-to-month predictions are. And unless my forecast for Canadian shipments to the US rises substantially, at some point, it seems likely that US imports are probably going to slow, at least relative to the 5-year average and relative to where they've been in the first quarter of the 21-22 market or 22-23 marketing year. Okay, so here's the Canadian canola oil supply and demand. And if you look down at sorry, this is the US. Sorry, this should be Canadian. If you look at where our expectation for Canadian exports is at 6.3 billion pounds, and USDA's is about 880 million pounds above where we are. However, if you look at, again, month-to-month Canadian canola oil exports, you can see that they haven't been particularly strong. In USDA's prediction for a 26% increase is substantially higher than what has been realized so far, which is basically a 4% increase. So either in the last 6 months, 7 months of the Canadian marketing year, Canadian oil exports are going to need to jump up dramatically above where they were in 2021, or US imports are going to be lower. USDA is going to need to lower their US number and then probably cut their non-biofuel forecast for the US. What I think they're doing is I think that they are coming at this from the US demand side and then using a number for Canadian canola oil exports that fits with the Canadian balance sheet, obviously, but also provides sufficient supplies to meet their US import number. And that's a great way to do this. But if the monthly data doesn't support it, it's kind of hard to make that prediction. Now, it's not, I've got a whole theory that's based on something that the monthly data doesn't support right now. So I'm not trying to criticize the way that USDA is doing it, or to say that there's no chance that their forecast is correct. All I'm trying to say is that if you just look at what the monthly data has said so far, it doesn't seem to support the idea that Canadian canola oil exports will be high enough to support their prediction for US canola oil imports, unless they're assuming a significant volume of imports that's coming from someplace other than Canada. All right, Malaysian palm oil supply and demand. Again, very few people actually look at the USDA, but since we're gonna get the USDA numbers for it, we might as well go through it. And it also gives me a chance to talk about something else, which I really want to talk about. Here, our differences to USDA are all really, really minor. There's not any place that we are significantly different. My import number is a little bit lower. That's primarily because I am still feeling a little burned by sort of the low imports that that started the year, and then we had a couple of months of relatively large imports. So I started the year closer to USDA. I cut it really hard, and now I've come back up about halfway between where I was before and my high number and my low number. And we'll see what the Malaysian Palm Oil Board says when they release their monthly report on Friday. But here's the thing that I wanted to talk about, which is the expectations for a transition from the multi-year La Nina episode that we've had to neutral or an El Nino. And if you look historically at sea surface temperature anomalies, what generally happens, particularly after a strong La Nina, is that there's an extended period where conditions are essentially neutral, are essentially between a half a degree centigrade and negative 1/2 degree centigrade from normal. But right now, if you look at the forecast, there's a 33% chance that those anomalies rise above 1 degree, which is considered a strong El Nino. In the summertime, basically July, August, September, and a 52% chance that happens in September, October, November. Now, this is really important because if essentially what happens with El Nino and La Nina, and why it's so important, is because it shifts where air rises and falls in the atmosphere. And so rising air, moist air goes up into the atmosphere. As it cools, the water in the air precipitates out of the air, and then it falls down as rain. And La Nina tends to focus thunderstorms in Southeast Asia and makes South America drier, which is obviously what we've seen in Argentina. If we shift to a strong El Nino, then you get almost the exact opposite, where the long-term trends or the long-term, I guess, realized deviations from normal rainfall tend to say that Malaysia, Indonesia, Southeast Asia is drier than normal, and in South America isn't necessarily wetter than normal, although some parts of it are a little bit wetter than normal. But it does suggest that maybe if we get into this strong El Nino late this summer or early this fall, that rainfall in Malaysia could be restricted. The last time that we had a really strong El Nino was in 2015-16. It's not the last time we've had an El Nino, but that was the strongest sort of long period that we had. And just to be clear, if we go up and we're at 1.1 degree for 1 month or 2 months, and then we start to move back down, that's not sort of the situation I'm talking about. I'm talking about we go up to 1.1 or 1.2 or whatever, and then we stay there for the next year, 6 months, 9 months, whatever it is. If that happens and rainfall is restricted in Malaysia, then that will obviously result in less palm fruit production and less palm oil production over time. Now, any fruit-bearing plant or tree, if you stress it a little bit and then give it rain, will produce a bumper crop. But if you just cut the rain off and don't give it any more, then you're going to reduce production. And if we make this rapid transition from La Nina to El Nino, it looks like you probably start to cut rain off in late fall over the winter, maybe. Now, it also takes 6 months for changes in weather patterns in palm producing areas to actually impact production because they're trees. And so the impact of that would be something that probably would be felt a little bit more a year from now, maybe a little bit more than a year from now. But it's something to keep in mind, especially if Argentina doesn't come back, the US export market is essentially shut. We do get an increase in Brazilian production and probably Brazilian soybean oil exports. So the world can still probably remain relatively well in balance in terms of vegetable oil supply and demand. However, if you start to add these things up, palm oil, soybean oil out of the US and Argentina, and then sunflower oil out of Ukraine, it could be that a year from now, we're back to a situation where the world is short vegetable oil, and then the market reacts a lot more like it has in the last couple of years than it has in the last 3 months or so. I think that I think a lot of things have to line up for all of that to happen, obviously, and it's something that I'm talking about that's going to happen maybe a year from now. But this idea that the world is better balanced, the supply and demand of vegetable oil is better balanced this year than it has been the last 2 years, I think is part of the reason that that we've seen the weakness that we have in soybean oil prices. I think what that does is it effectively puts a cap on soybean oil prices and exaggerates moves to the downside. Whereas over the last 2 years, you basically had a floor on soybean oil prices and by extension, other feedstock prices, and moves were exaggerated to the upside. So this is kind of just a background thing that I'll talk about every once in a while and keep you updated on, but it is a risk in the longer term. All right, now the other thing that I wanted to show you is, bear with me here, just 1 second, is our forecast for biofuel and in particular biodiesel margins. And I think my computer problems are all straightened out, so the data should be coming back and should be good. The forecast and everything should be good this week, and publish articles this week and all of that. Some of the data is already updated, some of it updates as I update this stuff. Anyway, okay, so for all of that, all right, what I really want to show here and what I really want to talk about just kind of quickly is this sharp decline in projected biodiesel margins. So the way that this forecast works is there's a sheet that calculates these margins, takes all of the credit prices, the feedstock prices, and fuel prices, and then calculates the margin, obviously. And that sheet is the sheets that predict RIN prices and that predict fuel prices and feedstock prices all feed into that sheet. And so what I do is I go through and I update all of that stuff, and then I kind of look at this sheet. And I was doing this last night, and I was really kind of surprised given what we've seen in terms of strength in biodiesel margins, to see that that it was predicting that basically biodiesel margins would go negative over the next month or so, drop from almost $1 a gallon right now to a negative number by the time we get to May. I'm going to go back and adjust this because mostly because the move lower is just too sharp to really be reflected. Although you can see there are plenty of sharp moves in these numbers, and we have come down pretty sharply from sort of the peak. But what I probably will do is make the slope of the decline a little bit lower and probably not take it down to a negative number. Now, just to be honest and transparent, the whole theory rests on this idea, the whole overproduction theory rests on this idea that we're not going to get rid of biodiesel productive capacity, and as a result, renewable diesel production is going to need to overproduce relative to the mandates. If this is actually true, then that kind of goes out the window. However, there's a couple of points that I would say to not entirely counter that argument, but just stuff to think about. One is that we've obviously had a period of really strong margins over the last 6 months and really over the past year. And if you look back to kind of a year ago, or back to when feedstock prices really took off and basically doubled, you can see that that biodiesel margins were really negative, but for a relatively short period of time. And we didn't lose a lot of biodiesel production capacity. Now, capacity utilization might have gone down a little bit, but people didn't close their plants because we were negative for a couple of months. And this prediction here doesn't suggest, I don't think, that biodiesel margins will go low enough or remain low enough for long enough to really convince biodiesel producers to get out of the business. Now, it does provide a way to solve the renewable diesel capacity utilization problem, because biodiesel capacity utilization has been more flexible historically than the relatively short history we have with renewable diesel. And because some of the biodiesel plants are integrated with crushers have the option to either produce biodiesel or to sell soybean oil to non-biofuel users or to other biofuel producers. And so that part of the biodiesel capacity can be kind of turned on and off depending on the market conditions. And what this chart suggests, I think, right now, is that there is the potential for biodiesel capacity utilization to be a little bit lower than it has been recently, and that would help offset some, or it would give the space to renewable diesel producers to produce at capacity utilization rates that are more in line with their historical average. This is really the first thing that I found that has provided an out for this whole theory. And so I want to highlight it before I change the forecast to something a little bit different, because I don't want to get caught in the trap of thinking that soybean oil prices are always going to go higher, always going to go higher, always going to go higher. It's easy to predict higher prices when you see all of the renewable diesel capacity that's going to come online. Predicting higher prices in 2021 and early 2022 was really kind of easy. but now it's much more difficult because prices have come down. The initial sort of speculative fervor is kind of gone away with the EPA mandates. And so now it becomes a little bit tougher. And I don't want to ignore any evidence that prices could go lower, because I happen to think one way. And so because of all of that, I wanted to highlight this to you again before I changed it, and it goes back to showing I don't think I'm going to keep it at, I don't think I'm going to keep margins at $1 going forward. I don't think I can. But again, I'm probably going to slow the decline down a little bit. How that's going to work is what I'm probably going to need to do is raise my forecast for biodiesel prices. In the California market, what we've seen is something that's been a bit of an anomaly, where typically renewable diesel trades at a premium to biodiesel. But because so much renewable diesel was shipped into the California market relative to biodiesel, renewable diesel prices actually traded at a discount to biodiesel prices over the last several months, and in a fairly substantial discount in 1 or 2 of those months. And it looks like that probably has peaked, and the traditional premium for renewable diesel will probably reestablish itself over the next several months. So raising biodiesel prices would take us back, unless I raise both, which is difficult to do unless I think energy prices in general are going to go up. Raising biodiesel prices without raising renewable diesel prices would either reduce that premium or again put biodiesel at a premium to renewable diesel, which is just not a natural state for those prices. Biodiesel, nothing against biodiesel, but it's just a little bit tougher to work with because it's not a drop-in fuel. Renewable diesel is, and so that's part of the reason that renewable diesel does and should trade at a premium to biodiesel. So raising biodiesel prices looks difficult. Lowering feedstock prices would do it. But then if I lower feedstock prices, I'm probably also going to lower RIN prices, and that's going to offset most of the gains in margin that would have accrued because of the decline in feedstock prices. And so I'll be honest, I'm not entirely 100% sure how I'm going to do what I plan to do or what I think I need to do. But I do think that this is, again, just probably a little bit too fast of a drop for biodiesel margins. Now, the other thing to consider in this is that, again, both of these margins are dependent on our assumption for the feedstock mix, and our renewable diesel feedstock mix is fat and grease, and our biodiesel feedstock mix is 75% soybean oil and 25% yellow grease. So very dependent on soybean oil prices. And so that leaves me with the one area that I may be able to do this is by lowering expectations for the refining margin for RBD soybean oil going forward. Now, the margin has been coming down from the peak that we saw in 2022, but it's already, like I said, I think last week, it's already sort of between the 7 to 10 cent range that feels pretty comfortable for it. And I don't think that we're going to go all the way back down to the historical level of sort of 3 to 4 cents. So there's not a lot of room that I have there to change that, but that probably is the one area that I'm going to that I'm probably going to look at and see what the impact is to make this change. All right, while we're here, let's just talk about RIN forecast really quickly, and then I will get to your questions and very much appreciate those. RIN price forecasts this week. I made a lot of adjustments to what the models wanted to predict primarily because one of the way that for the D4 RIN, I use the D6 RIN and then the HOBO spread, or effectively feedstock prices, to predict the D4 RIN. If you look and for the D6 RIN, what I use is a combination of the feedstock price, production, and then RIN generation, and then RIN retirement, so net RIN generation, to try and predict the D6 RIN price. And if you look forward to next year, the spread between the feedstock cost for ethanol production and the value of ethanol production starts to narrow and drop to a level that it hasn't been in a while. And this is due in part to the fact that in my forecast, corn prices remain relatively high, because if you look at the corn soy ratio, or the soy corn ratio during February, which is when the revenue insurance rates are set, the revenue price rates are set for each of the commodities, that ratio was historically high, which suggests that we'll get more soybean acres than corn acres relative to whatever sort of the traditional change would have been. And that may be true. It's impacting my corn price forecast right now, but planning decisions are driven primarily by, one, weather conditions when farmers are planting in the spring. The wetter the spring, the later the planting, the less corn that they plant, the more soybeans they plant. Although that impact actually has been reduced a little bit over the last couple of years, because farmers have started to plant soybeans much earlier, and they figured out that if they do that, they have a better shot at generating higher yields. But right now, that drives an expectation for lower corn acreage in the U.S. this summer, and supports higher corn prices when we get into 2020, late 2023, early 2024, and then that reduces the profitability of ethanol production. And so the D6 RIN wanted to be a lot higher than it was, particularly again in sort of this late 2023, early 2024 period. And that would have pushed the D4 RIN up significantly higher. And so relative to what the models predicted, I moved both of those a little bit lower. Now, I didn't want to trim them down more than I did, just because the model has done a fairly decent job historically of at least getting the trends right. But it would have had prices for both up where we were sort of at the end of 2022, and that just doesn't feel right, based on the idea that, you know, there will be more electric cars, there will be e-RINs and all this stuff. So I adjusted these a little bit more than I do during the normal week. Okay, enough of me talking, and let's get to, wow, lots and lots of questions. Imports are forecast to be 303 million pounds in both the USDA and Fast Markets forecast. What oils are included in that number, and how much of each oil will be imported? Excuse me while I look away here for a minute. 303 million pounds. So I'm not 100% sure. Oh, okay. 303 million pounds. Sorry. Okay, now I'm with you. So the 303 million pound total is for the 21-22 marketing year, and that's data we've already realized, and it's just for soybean oil. That balance sheet that you saw is just the soybean oil balance sheet. So that's just soybean oil imports. And typically the US imports about 300 million pounds of soybean oil. I think one of the questions going forward is, there have been times in the past and right now, if you look out over the next 10 years, my soybean oil import forecast is a little higher than it has been. I don't know that we will import as much soybean oil as I'm going to forecast, but the soybean oil is the balancing feedstock for renewable fuel production. And so that whatever that number is, it's more a reflection of a gap between anticipated feedstock demand and feedstock supply than it is I'm going to pound my fist on the table and say we're going to import this much soybean oil. Whatever that number is really kind of says is that there's this gap. It probably will, there probably will be several solutions that reduce that number back down closer to where we have been historically. Importing soybean oil into the US is difficult because there's a 19% tariff on US soybean oil imports. And as long as that stays there, it becomes really difficult to import huge amounts of soybean oil into the US. So the next question, and again, sorry for looking off. The next question is, how much UCO did the US import in the 2021-22 season? How much are you anticipating in 22-23? It's always difficult to there's no specific HS code for UCO. So the way that we estimate UCO imports is we kind of go by the country of origin. And what we do is we kind of say, okay, well, if yellow grease imports come from this country, then we assume that it's UCO. And that doesn't give us the exact number, but it does give us a number that if we do that consistently and adjust it when we think that there are developments that warrant changing the countries that we use, which we do, then it at least gives us directionally what we think is correct in terms of imports. And so while this spreadsheet is opening, the one thing that I will say is that given sort of that shortfall that we see in longer term soybean oil imports, or the increase in soybean oil, projected soybean oil imports, UCO is probably one of the answers that reduces that number. And it probably comes from places that we traditionally have not imported a lot of UCO from. Now, UCO imports from China are already starting to happen. In the extreme, very small probability, you could potentially see, and I don't even know what scenario I would sort of construct to get to this point, but you could potentially see UCO exports from Europe to the US in kind of the extreme situation. Okay, so our estimate for, and again, sorry for looking off here, our estimate for UCO imports for 21-22 was about 325 million pounds, up about 100 million pounds from 2021. And for 22-23 right now, we've got it at 350. And we kind of grow it by 25 million pounds a year. I think that one of the things that we have done, I talked about this a long time ago about changing the way that we look at try to estimate UCO production in the US. One of the things that I've done over the past month or so is come up with what I think is a better model for UCO production in the US. You won't see that in the forecast sort of immediately because I want to make sure that it kind of makes sense and doesn't go off the rails someplace. But I think that there's a good chance that you probably have a little bit better production increase in the US, even though just from our estimates, not year over year actual UCO collection, because that should grow at basically economic growth and in population growth or restaurant growth or spending on food. Any one of those things, all of them imply sort of 2%, 3% year over year growth at this point, given where we are in developing the infrastructure to collect and deliver UCO to biomass-based diesel producers. So I say all that to say that right now, while we do sort of the 25 a year thing, what we're going to do is if that model works out, we're going to kind of start to modify our production forecast for UCO in other parts of the world. And then that will make it so that our UCO import forecast into the US is a function of that, instead of just kind of a, this is what it looks like it's been in the past, and this is what we're going to use going forward. All right, can you break down the price moves that resulted in the renewable diesel and biodiesel margin coming so close to each other in December 2022? It was really a function of the of that flip in the price in the premium for renewable diesel. So what you saw was renewable diesel prices in the California market came down and were trading at a discount to biodiesel. And so you had biodiesel prices that provided more income, and that's why you saw the narrowing of that spread. Because we use soybean oil on the biodiesel side, the cost part of biodiesel tends to be a little bit higher than it does for renewable diesel. And so that's kind of what it takes. In our estimates, biodiesel will always be at a little bit of a disadvantage to renewable diesel because of the feedstock mix that we've chosen to use. And we chose to do it that way so that we could, one, because generally there's a little bit more soybean oil used in biodiesel production. But two, it also provides a contrast so that not only can you see kind of what renewable diesel and biodiesel margins are doing, but also if you think about it, you can think of it as renewable diesel this is what margins look like generally if you use fats and greases, and biodiesel is what margins look like if you use vegetable oils. Now, of course, if you produce renewable diesel out of vegetable oils, your margins are going to be a little bit different. And if you produce biodiesel out of fats and greases, they're going to be a little bit different, going to be a little bit higher. But this way you can, the graphs provide sort of two levels of understanding about what's going on with margins in the US. But in terms of December 22, absolutely 100%, it was a function of, in the California market, biodiesel was trading at a premium to renewable diesel. Mid 22, the follow-up question is likewise, why are they so far apart from each other mid 22? And that is because that premium wasn't there. The premium, historically, renewable diesel trades at a premium, and in mid 2022, that's where the prices were relative to each other, and so that's why you get that spread. Just to confirm that I understand the theory for the spring this year. Argentina won't export soybean as much. US will have to fill the soy gap and export more. Canola imports from Canada won't fill the gap for vegetable oil because production has increased just 4% this year. Renewable fuel companies will overproduce, increasing the oil demand. Probably the margins for renewable fuel will reduce due to higher feedstock prices. Biodiesel companies will suffer more than renewable diesel companies. So let me take these sort of point by point and try and go really quickly. That whole theory I really think is a second half of the year kind of phenomenon. So in April, I think that you start to see, I've got a chart of sort of average daily soybean oil usage. And if you look at that chart, I think the line crosses over the 5-year average kind of in April and then kind of starts to build from there. Maybe it's the average daily soybean oil usage in biodiesel production or biomass-based diesel production. It starts to cross over there, and I think that's probably when you start to get a bottom in vegetable oil and in feedstock prices more broadly. Right now, part of the weakness in feedstock prices is because renewable fuel, the feedstock demand hasn't quite been as strong as anticipated, because production hasn't been as robust as we thought it was going to be. And so there's some extra feedstock that is kind of floating around looking for a home, basically. I think we're getting close to working through that additional feedstock. And so then the next thing to happen is to raise feedstock demand enough that you start to get prices to follow. And so I think that raising feedstock demand probably occurs in kind of April, May. And then I think it takes the market a little while. And I think it takes a little while to work through all of the additional feedstock. And then you get prices in the second half of the year are probably higher than are either at or above fair value in the second half of the year. And I think fair value for soybean oil futures is around 65 cents. Argentina won't export soybean as much. I think that soybean oil, I've cut my Argentine exports a little bit. And I talked a little bit about this last week. If you look at the Argentine crop, it's down a lot relative to expectations earlier in the year, but there are a couple of things that will mitigate that impact on crush. One is that Argentine farmers generally use soybeans as a hedge against economic uncertainty. The Argentine government depends on agricultural exports for a significant portion of its foreign reserves, and so they have an incentive to incentivize farmers to sell those soybeans to crushers. And so the impact on the crush so far isn't that great. If I have to cut my Argentine crop further, then I'm going to have to start to cut into crush, because I've already taken soy exports down as much as I could. And basically I'm just left with crush to reduce. And in that case, then Argentina won't export as much soybean oil as I expect. And the Gulf may have to fill some of that gap, although it's much more likely that Brazil is going to step in and fill that gap, because the Brazilian crop is actually larger than expected. So Argentina went from 50 million tons expectations down to 40, we'll call it right now. Brazil went from 150 up to 156 or so right now. So you can see Brazil offset most of the losses in Argentina. They probably will crush more and then export more. Brazil traditionally isn't a large exporter, but there are times that they have been, and this year is probably one time that they will. Canola oil imports from Canada won't fill the gap for vegetable oil because production has increased just 4% this year. No, it's exports that have that have increased 4% year to date. The Canadian canola crop was actually significantly larger only because there was a drought the prior year. And so Canadian canola production right now is kind of in line with what you would expect for trend. And my question there really is, if we're sort of halfway through the Canadian marketing year and exports have only increased 4%. Now, granted, the first couple months of that probably they're still dealing with restocking from the drought and that kind of thing. And so in the second half of the year, crush and exports could be greater. But I don't know that they're going to go from the 4% that's been realized so far up to USDA's 26% increase. And we'll see how much that happens. Renewable fuel companies will overproduce, increasing the oil demand. Renewable diesel companies, if you look at the capacity utilization implied by the volume suggested by the EPA mandates for renewable diesel, assuming that nothing happens to biodiesel production, that it continues to sort of very, very, very slowly decline from the peak, sort of like it did last year a little bit, then the capacity utilization for renewable diesel is below where it has been historically and below where those plants are going to operate. And I mean below like 50% or something like that. There's just no way that those plants are going to open up and operate at 50%. They're going to operate at 85 or 90% or whatever. And so that's where you get the overproduction, is that difference between sort of the implied capacity utilization given no significant change in biodiesel production and the capacity utilization that renewable diesel plants will run at, just because big investments, new plants, they are going to run when they open, as long as they can get their pre-treatment processes going. Probably the margins for renewable fuel will reduce due to higher feedstock prices. I would say probably the margins will reduce. I think it'll be a combination of lower fuel prices, and I think that's probably the main reason. Not significantly lower, but just slightly lower fuel prices. And then higher feedstock prices come in the second half of the year, no matter what happens to fuel prices. And then that narrows the margins. Now, the thing that you have to remember about that is RIN prices are correlated with feedstock prices. So as feedstock prices go up, RIN prices will also go up. And to offset the additional cost for feedstock. And so even if you get feedstock prices to go up, it will have an impact on margins, but it will be reduced by that increase in RIN prices. And so that leaves you with really margins become mostly a function of fuel prices. Biodiesel companies will suffer more than renewable diesel companies. That's what it looks like to me right now. But again, also remember that biodiesel margin line is also a reflection of using soybean oil as a feedstock. So if you use soybean oil as a feedstock, whether you're a biodiesel producer or renewable diesel producer, that's the expectation right now. But I do think that I probably am going to reduce that soybean oil price or the refining margin for RBD a little bit, just to smooth that line out a little bit. Now, ultimately, renewable diesel producers will buy crude, not RD, but we use RD in the calculation, basically. What are the primary drivers of RBD basis above soybean oil futures? What makes up the current 10-cent a pound premium, and how does this compare to what drives soybean oil, the soybean oil futures market itself? So the refining margin, you can think of RBD basis as having two components. One is the refining margin, and the other is the crude basis. So crude has a basis to futures, and then you add a refining margin on top of that, and you get RBD basis. The 10% the 10-cent premium right now is mostly refining margin. Crude basis has dropped down to last week, I think it was around 2 cents, which is still kind of high relative to history, surprisingly. I think ultimately in the longer term, as renewable diesel producers start to use more crude, that crude component of basis will expand and the refining margin will reduce, will move lower. That leaves RBD basis basically kind of unchanged, although maybe a little bit lower, where that refining margin ends up. What drives that refining margin really is RBD demand relative to refining capacity at this point, because we are close enough to topping out the refining capacity that that RBD basis and the refining margin part of RBD basis exploded last year, triggered a whole wave of expansion plans by crushers. And those expansions will help mitigate that refining margin in the future. And then you'll have, again, renewable diesel producers shifting from RBD to crude as more pretreatment comes online. And so what that will leave to drive the RBD basis, or the refining margin portion of the RBD basis, is just the demand from non-biofuel users. The vast majority of that is, not the vast majority, the majority of that is for food use. And so it really comes down to how much people eat out and how many potato chips they eat at home. Oh, and how does that compare to what drives soybean oil futures? Everything drives soybean oil futures. There are a lot of things that drive soybean oil futures. Obviously, the world, I guess this is one thing I'll say. The one thing that has changed for soybean oil futures between this year and the last couple of years is the world situation. So soybean oil futures are a world contract, but they're delivered into the United States. They're physically deliverable. You can take delivery of soybean oil from the contract. It's difficult. The crushers are really the only people that can actually take delivery. But in theory, you can take delivery of soybean oil from a futures contract. And so because of that, but the world comes to the US market to hedge its soybean oil exposure. So part of what drives soybean oil futures are world supply and demand. And part of what drives it is the domestic supply and demand. The increase from 30 cents to 60 cents or 70 cents was due to growth in domestic demand, or anticipated growth in domestic demand. The decline from 70 cents down to 60 cents is due in part to the fact that over the last 2 years, the world has been short vegetable oil. And so you had a bullish world situation and a bullish domestic situation, and that exaggerated the upside move in soybean oil futures. Now the world is more balanced, and so you don't have that additional fuel for rallies in soybean oil futures, but you still have basically the bullish domestic scenario. And so while soybean oil futures have come down off the highs and are moving lower, there is a floor to how low they can go. I think that floor is around 60 cents, in part because of what's going on in Argentina. But if you look at the weather maps today, it looks like we finally are getting the long anticipated shift, and we might get consistent rains in Argentina. A big chunk of the crop is already set pods and is in pod filling right now. So there is going to be yield loss and there is going to be real damage to the crop. But if those rains actually verify, that will help limit the damage in Argentina. I don't think that it will limit it enough that I'll be raising my forecast up to 45 million tons, but we'll see how much it rains and when the rains actually start, or if they start. I could raise my forecast, but I also don't think I'm going to be cutting it down much more either if those verify. Do you use forward curves for the front 3 months in your soybean oil forecast? No, my soybean oil forecasts are more a function of the supply and demand fundamentals in the US primarily first. And then beyond that, what I look at as sort of a fine tuning for prices in any given month is oil share. If you look at oil share tends to trend. Now, that doesn't mean that it can't move lower one month and higher the next month, but in general, oil share tends to trend slowly, and the trends reverse kind of slowly. And so if you have an opinion about oil share and a trend, then you can use that along with a crush margin and a soybean forecast and a soybean meal forecast to set your soybean oil forecast. So I look at the forward curve. Basically, I look at the front month price in a little graph that you see every week for my soybean oil futures forecast. Pretty much, I don't ever want the current price to be out of my price range. So if that happens, I'll adjust my forecast higher or lower, and there are other reasons that I adjust it too, but I don't ever want that to be out of the price range. That's the only way that I really use the futures market to forecast prices. How does biodiesel profitability in a flat RIN forecast affect the UCO and yellow grease forecast for the rest of 2023? So if biodiesel margins are going to, let's just say that biodiesel chart is true and that is actually what is going to happen. What I would expect is that feedstock prices probably will be weaker than I expect. Now, I don't think that means that we move down substantially from here. Doesn't mean that we can't move down another 5 cents from here, which is substantial for sure, but it doesn't mean that we can't do that. But I think in the long term, the average is probably going to be is going to be above where we are today. Whether that above where we are today is 10% or it's 30% will depend a lot on the biodiesel profitability. I think if biodiesel profitability is what that chart showed, again, I think that prices probably move down a little bit because it relieves the pressure on feedstock demand from renewable diesel producers needing to produce at a capacity utilization that makes sense for them, makes economic sense for them. If that isn't really realized and biodiesel margins remain they can still come down. If biodiesel margins last week were $1, they can still drop down to 50 cents and they'll still be sort of in the upper end of the historical range. So that's not going to, that may slow biodiesel production a little bit, but it's not going to really cut it enough to make a huge difference. So I haven't done a very good job of answering your question. My expectation personally for UCO and yellow grease prices is that we are probably at or close to the lows for the year. In the next month, 2 months, there still is probably some excess feedstock that needs to find a home. And so again, prices may move a little bit lower. Then after that, I expect that unless biodiesel margins are really negative, that that feedstock demand will start to rise, and then feedstock prices will start to rise. And so I think that that's probably where you're going to go. Okay, that is it for questions. All right. Sorry, this was the longest ever. I really appreciate everybody attending, and I look forward to seeing everybody next week. And thank you very much for all the questions. Those were great questions this week. All right. See everybody next week. Have a great week, everybody.